package I'm going to talk about actually is a combination of both the resilience and the solidarity package. The three things I'll talk about today, I'll start with what's the current economic and market outlook and where the solidarity package actually fits in, and also a little bit of in terms of the considerations for SMEs in particular. If you look at the three economist covers that I have put down here, it's actually quite interesting because if you think back, just in 1st February, the Economist front page was asking, how bad is it going to get? Then before February was over, they said, okay, this COVID-19 pandemic is going global. And then lo and behold, not even 1 month later, on 21st of March, they have the same picture of that globe, except now it has a big close sign, okay? So it just tells you how fast this COVID-19 pandemic has actually evolved, okay? It does also reflect, to a certain extent, what's happening on our domestic shores. The chart on the right also is quite interesting because this one I pulled out from the Financial Times. It tells you how, as this whole COVID-19 pandemic actually evolved, there has been a mad rush for cash. So what you see here is some of the largest companies in the world essentially drawing down on their credit lines because cash is king in this kind of environment. So just bear with me while I walk you through what's the current climate, and then I'll sum up with some recommendations for you to consider towards the end of the presentation itself. If you look at the COVID-19 pandemic, how has it evolved? We all started with a very China-centric story, right? The cases in China, especially in Wuhan and Hubei province, were actually rising very, very rapidly. But what you have seen in the last couple of weeks is that actually the total number of confirmed cases outside of China has rapidly overtaken that of China. So what it suggests is that, actually the COVID-19 pandemic has gone from a very China-centric story and is now a global story, which is why if you look at the key economies like the US and Europe, actually they look like they are actually headed for a recession, okay? Then you look in terms of the fatality rates as well, okay? Although you would think that, Europe and US would have better healthcare systems, compared to some of the developing countries, nevertheless, because of their aging population, and maybe because of the lack of testing in the initial days, actually the fatality rate has also overtaken that of what we saw in China. And then if you look within Asia itself, okay, we are seeing the same kind of a number counting in terms of what are some of the issues with new confirmed cases, fatalities, and now, of course, what we see in Singapore itself is also a second wave of imported cases, but also the local transmissions. So it's still a rapidly evolving story. We are looking very closely at the number. And I think so far we are hopeful, but we haven't really seen the peak yet in terms of the total number of cases. And we haven't actually seen a stabilization in the total number of confirmed cases either. So this is the healthcare backdrop. But if you look at the economic aspects of this whole COVID-19 pandemic, actually it's a little bit more serious than that. It's effectively a black swan event. The reason why I say that is because it's no longer just about a healthcare crisis. It's actually an economic emergency, right? You look at what has happened to most of the global manufacturing PMI numbers. When China shut down because of the worker quarantines and the city lockdowns, we did see a lot of supply chain disruptions. And then you can see that a lot of the major global manufacturing purchasing managers index, which is the chart on the left, has fallen quite drastically. So at below 50 handle, essentially it suggests that it's on a contraction territory, right? But I think what's even more alarming is if you look at the chart on the right, which is the global services PMI, right? This is basically everything outside of manufacturing. So it really comes down to private consumption, financial services, and all the other slew of business services, professional services that is actually involved. And these usually tend to contribute the bulk of the growth engines for the major economies. And you can see that actually the drop in terms of the global services PMI is even sharper than that of the manufacturing PMI. So actually the supply shock that we saw in the initial days now has been replaced by a double whammy, which is really the demand shock being the second wave. And this second wave is going to be a lot more severe than the first wave. So if you look at our FX sentiment index, this tries to capture some of the volatility that we see in the financial markets, including FX and bond markets. you can see that actually in the past month or so, actually the risk-off sentiments have been very, very strong. We saw deleveraging, the scramble for cash, dollar was king. But what was interesting is that actually we have backed off a little bit from the very extreme levels of risk-off that we saw. And now we are kind of still in risk-off territory, still above at least, for a 5-year historical period. But nevertheless, it seems like we are kind of like trying to get a little bit of a handle on top of this COVID-19 pandemic. And I think one of the contributing reasons to that is mainly because we have seen governments and central banks rush to the rescue with a lot of rate cuts, emergency liquidity measures, and of course, fiscal stimulus after fiscal stimulus. So if you look across on the chart on the right, which is really the market implications, you can see that there has been a big flight to quality. Typically, your US Treasury bonds have seen a big rally, partly because the Fed has cut interest rates close to zero. But interestingly enough, there's been selling or deleveraging across most of the other assets because people are very risk adverse still at this juncture. So where do we stand today? As you all well know, actually growth forecast downgrades has been coming fast and furious. Okay, we are looking at a US recession this year. Okay, so you can say, well, last Friday when we got the US non-farm payrolls number, it didn't look that bad, right? Minus 700,000, but given that the initial jobless claims was probably like 10 million in the past 2 weeks, why the discrepancy? I think it's just the tip of the iceberg because the non-farm numbers only captured up to the 12th of the month. But whereas we have seen the big spike in terms of initial jobless claims in the US coming in the last 2 weeks. So we do think that there's a good chance that unemployment rates in the US is probably going to hit double digits, possibly close to the 20% handle that some of the Fed officials were warning about for the second quarter. So effectively, the US economy has hit a big speed bump. They will stall, they will see a recession this year. And I think it's a very similar story for Europe as well. You look at the cases that have popped up in Italy, in France, in Spain, okay, and how the European policymakers are also all scrambling now to find a coordinated response. So if you look at some of the key countries that we have highlighted here, okay, most of our ASEAN neighbors are going to be in recession as well. Last Friday, Malaysia just cut its growth forecast to as bad as minus 2%. Okay, the only 2 countries for now that actually seem to be still in the positive territory for growth for this year is actually China and maybe Indonesia. Okay, but I think of course there is still downside risk. It's very hard to see how this pandemic is going to evolve. And I'd like to talk a little bit about Indonesia, for instance, because although Indonesia is a large, relatively insular country, nevertheless, for them to deviate so sharply from the growth handle of around 4-5% to as low as 1.5%. And then there's a lot of questions because you see that the number of confirmed cases in Indonesia now is rising rapidly. And we don't know whether it's a true picture because of the lack of testing, but they have warned that, the infections may actually peak around 95,000. Fatality rate is also quite high. So we may actually see Indonesia possibly also sliding closer and closer to a recession story. So like I mentioned earlier, the reason why we are not at new extreme highs in terms of risk aversion is because central banks have rushed to the rescue. We already saw the Fed basically do 2 emergency rate cuts to bring in the Fed funds rate close to zero. They are pumping in liquidity. I won't go through all the details here in this very messy table because there's a lot of details here. But generally what I want to emphasize to you is that central banks are throwing everything they can at this problem, including the kitchen sink. Okay? And this has been actually the kind of context that we are actually seeing for growth today. So if you look at the first quarter GDP growth numbers for Singapore, okay, we did see a much bigger than expected first quarter growth contraction at minus 2.2%. Okay, this is the worst since the first quarter of 2009, which was back during the global financial crisis days. Okay, it's also the first time that we see all 3 growth engines, manufacturing, services, and construction, all contract at the same time. Okay, and we haven't seen this actually since the Asian financial crisis. So we saw a very drastic slashing of the GDP growth forecast by the Ministry of Trade and Industry. Just in February itself, they were actually tipping growth to be about minus 0.5 to 1.5%. But once the COVID-19 impact was becoming clearer from an economic perspective, they slashed it all the way down to -1% to possibly -4%. And mind you, actually this growth forecast came before the implementation of this 1-month circuit breaker that starts today. So actually there could be even further downside risk. So the idea here is that, we really don't know, and we're all trying to feel where the bottom is right now. Okay. Even at -3%, which is our house view for this year, you can see on the chart on the left, this will be the worst growth we have seen since even the GFC or the AFC for that matter. Okay. So we are looking at a recession story for this year. Okay. If you look at the manufacturing electronics PMI numbers, we have fallen to unprecedented contraction territory. It is very likely the second quarter will be worse. A technical recession is probably on the cards. When we forecast that second quarter GDP growth would be at -7% year on year, again, this was before the implementation of the 1-month circuit breaker. So what's quite clear is that both firms and workers are reeling from the effects of this COVID-19. And we do expect that the labor market will soften further. Okay? So unemployment rate has been very well behaved around the 2.1, 2.2, 2.3 kind of a handle for a very long time. We do think that there's a possibility that we could see it rise closer to 4% this year. Okay? Monetary policy has also been on the rapid catch-up. October last year, MAS already flattened the slope for the trade-weighted Sing dollar. And just recently, on the 30th of March, they actually brought forward their April meeting, and they did a double-barrel easing. First, they flattened the slope, as you can see on the slide on the right, to a zero appreciation bias, meaning no more medium-term appreciation for the Sing dollar on a trade-weighted basis. And on top of that, they actually recentered the slope lower. Okay, that's to reflect some of the deflationary pressures that we see coming through in the Singapore economy this year. So let me move on to the budget per se and where fiscal policy will come in to do the heavy lifting. 18th of February, we saw DPM Heng basically announce the unity budget that was followed in very quick step by the resilience budget on the 26th. And then now we have the solidarity budget all within 2 months. Okay, so the timing between the budgets are getting shorter and shorter, and it reflects how fast this economic deterioration is happening. Okay? So this is a very nice summary slide of what they are trying to do in terms of the support measures to try and build resilience and build solidarity in the Singapore economy. Basically, to sum it up, they are going to spend close to $60 billion this year. That's about 12% of GDP, numbers that we have not seen even during the global financial crisis. And what is quite interesting about this recent budgets is that both the resilience and the solidarity budget will require draws on past reserve. So this is the second time they are drawing on past reserves, and they are doing it weeks together. So second and third time together, requiring 21 billion in total. Okay. So it's quite clear that we don't know how far or how badly hit this 1 month circuit breaker is going to affect the Singapore economy. In fact, if you have read the news, Minister Chan Chun Sing is now saying that they don't know whether actually the 1 month circuit breaker needs to be extended as well. So we are watching the 4th May deadline quite closely. I think in terms of the local transmissions, if it doesn't stabilize, I think there's a good chance they may actually extend it further. This is because if you look what happened with other countries, I'll give you 2 examples. One is Malaysia, when they did a 2-week Movement Control Act lockdown. They basically had to renew it for another 2 weeks, and the date is coming up very soon, 14th of April. Wait and see whether they're actually going to do, what they're going to do from there. Then if you look at the China example as well, when Hubei province was actually locked down, and if you look, they only recently started to lift some of the restrictions and the lockdowns, and it's been at least 2 months plus. So the fact is, this COVID-19 virus is actually a fairly smart virus. It takes quite a lot to try and control the situation, and it requires the participation and the support of everyone, right? Now let me talk a little bit closer about what the solidarity measures are about. Okay. So let me share with you some of my key takeaways. Okay, I mentioned already the COVID-19 support now extends to almost $60 billion. That's almost 12% of GDP. It's not the highest in the world because Germany is talking about 20% of GDP. And if you look at some of the numbers that have been thrown out by Japanese Prime Minister Abe, he's also talking about 20% of GDP. If you look at last week's announcement by Malaysia, they were also talking about 17% of GDP. So by no means is this the highest, although it is among the higher group of people pushing out fiscal stimulus. Do they have scope to do more? I certainly think they do, and they have the willingness to do more if need be. Okay, I think DPM Heng himself mentioned that he will not shy away from considering doing more in terms of fiscal stimulus and in terms of draws on the past reserves if necessary. The second point really is that, this draw on past reserve, actually the first time they ever did it was during the GFC. They said they were going to tap 4.9 billion. In the end, they only tapped 4 billion. And actually, within 3 years, they paid back the full amount, although there is no legal or constitutional requirement to do so. Okay. So I think some people who have been looking ahead said that, well, they're going to draw 21 billion. Depending on how the situation evolves, maybe if things get a little bit better end of the year or early next year, maybe they don't have to do the full amount. And maybe, if things really recover, the global economy actually recovers in 2021, 2022, I think they will also try to put back some of this draw, although they don't need to. But of course, now that the barn door has been opened, I think there will be some pressure. Every time you get a new recession, people are going to say, well, is it time to break open the past reserves again? So I think the moral hazard story is already there. I think the third point really is that this 1 month circuit breaker closure is really unprecedented. Shutting down for the whole Singapore economy, except for essential services, how big an impact are we going to see, to the whole Singapore economy? There are some estimates out there. You're talking probably of at least 50% of the Singapore economy going into a limbo mode or a sleep mode. There will be quite a fair bit of short-term pain. Of course, the question is how much of the pain can be relieved by the solidarity budget. But what's quite clear from both the resilience and now the solidarity budget is that the focus is very much on prioritizing local job preservation with a few tweaks. Okay? Basically, what's quite interesting about this solidarity budget now is that it's very broad-based. All the industries will get the 75% offsets for April. And in fact, interestingly, if you look, they are starting to also open the door on the foreign worker levies and the foreign worker rebates as well. So it's no longer a story where it's just prioritizing local jobs per se. And a lot of the assistance is now front-loaded. Assistance will come faster, the cash payouts will come earlier, and I think they are going to basically be a lot more generous, cast the net a bit wider. More self-employed persons will qualify. They are not going to nitpick about whether people stay in condos or private properties, and because they have faced displacement due to this COVID-19, they won't be applicable for SIRS. I won't talk too much about the foreign worker levy again. Solidarity payments, okay, that's quite interesting because if we think in terms of handouts, the Singapore government has always said they don't believe in cash handouts because it doesn't engender the right values. But nevertheless, because of the worker displacement story that we are seeing very sharply with this 1 month circuit breaker, we have seen a $100 payout in the unity budget go to $300 in the resilience budget, and now it's double again to $600 in the solidarity budget. So if you ask me, how far will they go if there is a fourth budget? Okay, I think it's very hard for them to go beyond 75% wage offset. Mainly because if they actually went to 100% wage offset, there will be a moral hazard problem, right? You will just take people onto your payrolls because you're not paying for them anyway, right? But I think there is probably some room if they want to increase the cash handouts to individuals, okay, especially to the retrenched workers or to lower to mid-income households. $600, if you look globally, I think the levels that are being talked about in the US and even in Hong Kong, it's still higher than that. So there is a possibility that they could increase the cash payments going forward if there's a need to. And then I think what is quite interesting is that, in the past two budgets, they have relied a lot on people doing the right thing, in particular, the landlords, for instance, passing on the property tax rebates. But now you're actually seeing bills being introduced in very quick fashion in Parliament to ensure that the property tax rebates are being passed on in a timely fashion. So this is a little bit of that stick coming out. Before this, it was all carrots and all moral suasion, but now we're starting to see the stick come out. So I think what will be also quite interesting to watch in the days ahead is because if you look elsewhere, when countries or cities do lockdowns and they do movement control, there is a lot of persuasion that is required to try and get cooperation from the local citizens themselves. In fact, you hear of some unwelcome news of people taking more harsher measures, to ensure that their citizens actually observe the stay-at-home notices. So I don't know whether it will come to pass, but I suspect that, basically they're going to get more and more serious to make sure that first, the support gets out there, and possibly secondly, that people do abide by what is necessary to get this crisis over. Okay? So I think looking here, like I mentioned earlier, Singapore at now 12% of GDP in terms of the COVID-19 support package is not the biggest out there, but we are rapidly catching up and we have space to do more. Okay? So this is a very quick summary of what it means for companies. Basically, you have some further wage cost help, both in terms of the foreign worker levy rebates and also the waiver of the levy for April. On top of that, you do get additional financing. The government now would take up to 90% risk sharing on new loans that are applied between 8 April to 31st March 2021. Okay. And for those who are actually tenants of government agencies, they will actually increase the rental waiver from 0.5 months to 1 month. And of course, like I mentioned earlier, there is this temporary measures bill that will ensure that the property tax rebate will get passed on in a timely fashion. And for those of you who actually are self-employed persons, there is automatic inclusion if you still earn a small income from employment work but has been affected by this COVID-19 pandemic. And like I mentioned earlier, now the net is a lot wider. If your annual value of your property is within 21,000, you will also enjoy it. And the cash payment is also accelerated. You will basically get it starting from May, July, and October. Okay. So this chart at the bottom is quite useful because it tells you exactly when the enhanced job support scheme payouts, the self-employed income relief scheme payouts, and the other payouts will apply. So basically you'll start from April onwards and you will extend through May, June, July, September, and October. I think one reason why they have not really gone into support schemes that go beyond the end of the year is because the situation is still evolving quite rapidly, but there's hopes that although this COVID-19 pandemic is going to be fairly protracted, it will not, drag on into 2021 itself. And anyway, in January, February 2021, that's when the budget 2021 will actually be presented. So maybe, if elections are held by then, it will be more appropriate for the new term of government to actually assess again where to take further support schemes from the end of the year. Okay. So this enhanced job support scheme, if you remember the resilience package announcement, actually there were some concerns that why is it that only certain industries like aviation get the full 75% wage support. So I did hear feedback, even from like some of the MICE operators or some of the other entertainment operators. They said, well, we have been very badly affected by the COVID-19 and the fall off in terms of visitor arrivals and all these social distancing measures as well. So I think this time round, actually the solidarity support actually now recognizes that, well, with the 1 month circuit breaker, actually all the industries are vulnerable. All the industries will actually be impacted quite severely, which is why for April itself, all sectors will get 75% wage support. Okay. But after April, then you will see the tiering again. Those that they deem to be more affected will remain at 75% for the qualifying months ahead. But The other sectors, apart from aviation and tourism and food services, which is kind of like in the in-between, which will get 50% wage support, the rest will default back to 25% wage support. Okay, but of course, this is an evolving story, right? If we find ourselves 1 month, 2 months, 3 months down the road, things haven't gotten better. In fact, if things had probably remained very in a stalemate situation, they could, of course, adjust these levels of support again. And for Singaporeans as well, I mentioned, you will now get additional $300, okay? So depending on where your accessible income is, you could get anywhere between 600 to 1,200. Okay? Of course, you can say that this amount is not going to be sufficient to, pay all your bills if you actually get laid off during this period. But I think it's more in terms of like emergency cash to help tide you over some of the immediate liabilities. Okay. So what are the conclusions from here? Okay, it's a tough time for everyone. If you are running a small or medium enterprise, what should you be looking out for? And this really comes back to the 3 C's. Okay, first really is cash flows. Okay, in this kind of environment when global demand is down, remember the global services PMI numbers that I showed you and also the Singapore PMIs that I showed you, demand is in a contraction mode right now. People are tightening their belts. They are trying to conserve cash. You do have to look out for risk, not only from the external front, but from within as well. Okay. So you have to go into a cash flow conservation mode. Okay. That means cutting out all the frills, reassessing where your operations can be streamlined, focusing on really the bottom line. And I think there is really no, shame in basically being proactive. Okay, you can see that MES has announced new measures for SMEs to actually defer payment of loans. And in fact, if you look at the 3 local banks, they've all come up with a lot of moratoriums, and temporary arrangements. Take the initiative to go and talk to your bankers. Okay, don't wait until you need the refinancing to find that actually the market is not available. So even if you have existing liabilities, go and talk to your bankers early rather than later to flag some of the potential issues and to ask for some of these moratoriums or to switch to an interest only payment issue or to delay some of the principal repayments to a further date. I think if you take the initiative to be frank and to be the early early in the game in terms of the negotiations, you may actually benefit. Okay, so cash flow is important. Secondly, if you look in terms of the budget measures, there have been a lot of measures that the government is trying to extend to help firms. Okay, so you can see in terms of the enterprise financing scheme, the trade loan quantum has been raised, risk sharing has been raised further. Okay, temporary bridging loan quantums have also been raised, working capital loan quantums have been raised, risk sharing bond by the government has been raised to 90%. Okay, don't be shy, go and apply for whichever scheme may help you. Okay, I think it's necessary to be as innovative and to be as looking in all areas in which you can actually try and get the financing in. Okay? I think one thing to also look out for in terms of the risk, which is what I mentioned earlier about the stick. There are some COVID-19 penalties that are coming through. So we have seen that, if you're an employer and you didn't put in place the appropriate social distancing measures, now there are basically financial liabilities and possibly even jail liabilities as well. Okay. Of course, we have this 1 month circuit breaker effect kicking in, but even if you are in the essential services industries and you will still be running a part-down operations mode, you do have to make sure that you comply with some of these social distancing measures. Okay? And then, of course, this new bill that's coming out, forcing property owners to pass on property tax rebate to tenants. I mentioned, I think, increasingly because the authorities are getting more serious at making sure that the incentives go to where it's required, we could see more sticks coming out as well. So I think you do have to bear in mind that even as an employer, you do have a certain obligations on this front as well. Okay? That's all I have. I'm quite happy to take any questions you have at this juncture. I've been talking for a very long time, and I, would like to pass the time back to Tiffany to moderate, and I'll be quite happy to hear your feedback or your sharing of your experiences or any questions that you may have as well.
Okay, thank you, Selena. Thank you for the wonderful, presentation. Okay, before we start off the Q&A session, I'll give the participants some time to click on the Q&A button below to post your questions, moving forward. And please note that the presentation deck will be sent to all the participants who attended in today's event. Okay, so not to worry on the presentation deck. So, on the Q&A button, please key in your questions that you have. During this period, because of the limited time, we may not be able to answer all the questions. And some of the questions may be technical questions that we will have to answer you back offline. So do bear with us if your questions is not being answered. So Selena, while we wait for more questions, people key in their questions, offhand, I do receive questions from people, emailing us, asking about questions on like, with the current market, you're seeing that recession is going on, jobless rate is going up, company default rates is also going up. But why is the market, like the US share market is currently still, moving up? Is it a dead cat bouncing, or, there's more to be expected in the coming months ahead?
Okay, I think actually there are two contributing reasons. First off, financial markets tend to be front runners, meaning that they are the fastest to react to news flow. So the hopes, that the infection rates in the US may be starting to slow, meaning that they haven't peaked yet, but they seem to be slowing a little bit. That's giving markets hope. Okay, so investors, like we say, is always caught between greed and fear. When they are fearful, they sell. When they think that things may be turning around, they will buy. Okay, so that's one reason I think that will explain the overnight bounce. Okay. But our core view really remains that, like I mentioned in my presentation, economic data is still going to head south in the second quarter. Okay, we are standing only in April, and things look like they are really falling off a cliff globally. There is a little bit of concern that this rally is not sustainable. I think the hope part really comes in because a lot of the central banks and governments have been rushing to put in place further fiscal and monetary policy stimulus. But the stimulus can only carry you so far. It can help to, dent the pain a little bit. It can help to stem any systemic risk, but it will not bring growth back in the short term. I think if you expect that government spending can fully replace the drop-off in private sector spending, that will be a very, very high task to deliver.
Okay, thanks, Selena. Yeah. Okay, I do have someone, asking on the question about the GDP projections of Vietnam and Philippines. Maybe just to add on a bit, what do you think about the ASEAN market in general, like in terms of their GDP projection and everything, especially a lot of businessmen, they have a lot of tradings and business going on, particularly in the Asia and ASEAN market this side. Yep.
Okay, all right. We didn't actually focus that much on Vietnam and Philippines because these are, well, Vietnam, for instance, if you remember last year, actually they were one of the key beneficiaries from the trade war, because the US-China trade war, there were all these tariffs being levied in retaliation between US and China, and Vietnam was seen as a very convenient conduit for a lot of the Chinese production fall off. But I think if you look at the infection numbers, I think there is no part of the world that is going to be immune from this COVID-19 infections. I think a lot of the underreporting could be due to the lack of testing. But given that we live in a global world today, the reason why it's a pandemic rather than a localized epidemic, I think the issue here is that all the growth numbers will be affected. So if you really want to know what's our forecast for Vietnam and Philippines, I probably can follow up with you directly on this. But I think you would easily take the knife to any country's growth forecast at the start of the year. you slash a couple of percentage points off. If for some countries it could be more than half, you're probably in a good realistic range from there.
Okay, I hope that that's answer on the GDP focus for Vietnam and Philippine markets. Okay, next up we do have Narine is asking about, I think it's a tough it's kind of a tricky questions. So her question is, what is your outlook for the Singapore economy based on the current situation? When do you expect recovery to kick in? Is there any telltale signs for maybe businessmen to know that, hey, these are the telltale signs that I need to look out for to know that Singapore economy is recovering in general? Yep.
Okay. I know this is a very Singapore-centric question, but let me start with the bigger picture. There are three things that I'm looking out for on the global picture. First is that global infection numbers start to slow down, peak, and then stabilize. That's the first milestone I'll look for. Second milestone is, are we getting closer to a vaccine? So now there's increasing talk about different drugs that are being considered. Many firms are now focusing a lot of their research efforts on developing a vaccine. If you do see light at the end of the tunnel that there are possible vaccines coming up, I think that's also the second milestone that we look for. The third milestone, actually, we are kind of approaching, but not exactly there yet, which is the global coordination story, right? In the early days, when the Fed did emergency rate cuts and then a lot of central banks rushed to follow, people said, where is the coordination? Why are they extending US dollar swap lines only to certain countries but not other countries? But now you see the Fed basically extended the swap lines to other countries outside of the G7. In fact, they have extended to MES and Bank of Korea. And now you see talk about the IMF also giving short-term dollar liquidity to countries that don't actually have the US Treasury bond holdings to go and exchange as collateral at the Fed for dollar liquidity. So those are the kind of signs that we want to see. Basically, the world working together to try and solve this problem. So you see a little bit of that coordination starting to emerge on the monetary policy side. We need to see the coordination emerge on the fiscal side as well. Okay. By the fiscal side, you remember when the G20 finance ministers had their virtual meetings, they all talk, yeah, we all need to do our part. We need to stimulate the fiscal part of the story as well, right? But you don't see the G20 ministers saying, okay, this is what we're going to do together at the same time, right? You see just various countries announcing their own different pots of fiscal stimulus. Okay, so I think if you have a very strong, coordinated global approach to this issue, whether it's on a healthcare basis, whether it's on the monetary policy side or on the fiscal policy side, then I think you could succeed in trying to stabilize the drop in confidence that we are seeing very clearly in both business and consumers today. And I think one of the reasons why we haven't seen this kind of global leadership, partly is because you look at what's happening in the US, right? The US example is that they have kind of given up their position in the global arena as the thought leader. They don't drive NATO, they don't drive WTO, they don't drive WHO or anything, or any multilateral institutions of that sort anymore, right? They are basically in election mode and firefighting crisis for COVID-19 as well. So a lot of finger pointing, a lot of, what we see now as hijacking of masks and other PPE kind of materials, but we don't see that kind of global leadership emerging. So for Singapore's case, actually, some of the things I'll be looking out for is kind of mirrored in what I'm looking out for on the global milestones, meaning that I want to see slow down, peak, and stabilize. I want to see the local transmission that's clearly coming through in the recent data also start to stabilize.
Thanks so much for the for the talks and everything. Okay, moving forward, I understand that quite a couple of the participants has been asking about like bridging loans, working capital with OCBC. Just like to share with the participants that moving forward, there will be another session with OCBC, particularly on the working capital on 21st April 3 p.m. So after this webinar, we'll be actually sending you the registration link for you to register. So for those who are posting questions on your bridging loans, what's the interest rate like, how to go about with the supporting documents, do attend the sessions on April 21st at the end of the day. Okay, so moving forward, I do have the next question by Adeline Toh. Okay, she's asking about, what's OCBC view regarding the direction of the USD, against Singapore dollars going forward?
Okay, I think at this juncture, actually, the FX market is very much reacting and very much sensitized to the headlines about COVID-19. Okay, we see a lot of the Asian currencies, including the Sing dollar, basically reacting to the broad dollar story. So if you remember, there was a, towards late March, there was a mad scramble for liquidity. Remember the earlier chart I showed from Financial Times about all the big global corporates drawing out all the credit lines. Why? They all were scared that we're coming to the month end, quarter end, dollar funding was unavailable, the CP market was drying up. They were afraid that with the credit deterioration going forward because of the economic recession story, a lot of the banks may start to pull their lines or turn very much more conservative in terms of the credit extension. So we did actually see a big dollar crunch, okay? And what happened with that really then contributed to this whole liquidity tightness. And that's why the Fed had to step in with the dollar swap lines again, which was something that they pulled out during the global financial crisis. Okay, so now that the Fed has extended all these swap lines, there is still a little bit of tightness, even though we are past the month and quarter end in 31st March. Okay, but I think there is still a bit of issue with now that the epicenter of the COVID-19 pandemic has shifted to the US. Right? So it's clear when there is risk aversion, when there's flight to quality, the dollar is king, right? Which is why we see dollars Sing actually spike higher quite a fair bit. And then in the run-up to the 30th March MES policy review as well, a lot of people were expecting the MES would ease monetary policy further. So they had already fully discounted that, the MES would move to a zero appreciation bias, which is what they did. And in fact, there was a lot of speculation as to whether they're going to recenter lower, whether they're going to do a big recentering lower, more than the current level, and whether they would actually, even possibly at some juncture, if things continue to deteriorate, move to a downward sloping, trade-weighted Sing, right? So that was one of the reasons why we actually saw the retraction in terms of the Sing within the trade-weighted band, all the way, to at one point as far as 1% kind of on the weaker side of the band. Not at the extreme level yet, but basically to reaccount for the recession prospects for the Singapore economy and the global, risk aversion story. Okay. So going ahead, after the MES move on 30th of March, basically we are back close to around parity, which is the center point of this trade-weighted band. Looking forward, I think the situation is still quite fluid. If you look whenever there is bad news coming out, whether it's on COVID-19 per se or on the economic side, you will see pressure for dollar Sing to move higher. So on a short-term view, I think there is still risk that dollar Sing will move higher in lockstep with most of the other Asian currencies, mainly because the dollar is kind of like the safe haven currency. Okay. I think what is one of the saving grace is that if you look at where the renminbi is trading, and renminbi kind of like typically provides a kind of anchor in times of volatility, because now that China is not the epicenter of the COVID-19 pandemic anymore, and Chinese economy now is pushing to reopen all the factories, getting the production back up to capacity again, allowing more travel within cities, etc. So this actually helps the Chinese economy. So although growth is going to slow, whether it's below 5%, below 4% is anyone's guess. But at least in this world where most people are in recession, China's not going to fare too bad. So what I'm trying to say is that China's renminbi will actually have a little bit of an offset. Okay, I think assuming that things do stabilize towards the end of the year, there may be a chance that dollar Sing will go back below the 142 handle, but the short-term risk is still to the upside.
Okay, thanks, Selena. I hope that answers, your Adeline's questions on the US to the Singapore dollars questions. Okay, I have quite a few of them asking similar questions on which sectors will be recovering the fastest from this pandemic. You know, maybe also how long, you know, will the recovery be? Will it going to be a U shape, V shape, or L shape? You know, kind of questions. Yes.
Actually, when I was interviewed by Channel News Asia yesterday, post DPM Hangs, I said it already. I said I don't think we're in for a V shape. Okay, at best, if we get U shape, we should be thankful. At worst, we may be actually in for L shape, right? So we just have to see lah. I'm not completely bearish because, you know, if you look at the last month or two, like I mentioned in my presentation, central banks are throwing everything, including the kitchen sink, at this problem. Governments are going all the way out. You know, even Singapore, typically being very fiscally prudent, is now, you know, drawing the reserves within weeks or, you know, twice in a row, and they are actually, you know, throwing 12% of GDP at the problem itself. So I think at some point, all these stimulus should help to stabilize global sentiments, okay? But maybe we're not quite there yet. Like I mentioned, some of the things we have to look out for is that global and domestic infection levels have to start to slow down. Hopefully we should peak and start to stabilize. We have to have sight of vaccine development, you know, possibly in the months ahead. And then, you know, when the data hits the bottom, or expectations for the economic data is so low that data starts to beat expectations, that's when we kind of know we may have hit bottom. But we're not quite there yet. So I do expect that second quarter will be really bad. You know, and we are in this game where we just keep revising the numbers now. In the past, when you make a forecast, you can say, okay, we'll revise it 1 month later or 3 months later. Now we are like kind of revising our forecast every week, every day. So it's a rapidly changing world.
So it's like almost every other day is like something, you know, new coming in, you know, for you guys, you know, to predict, you know, what's going on and stuff like that. So I hope that it answers some of the participants' questions. So the other questions that I also have from companies is, for companies with spare cash, what's your view, you know, in terms of this period of some of the good opportunities? Should they capitalize? Or, you know, the other question is also related to business financing. So any advice for business in terms of their financing planning since recession is coming ahead? So what do you think, like, you know, business should deal with, you know, at a current moment with recession is coming ahead? Nobody may know how long it will last. You know, should they be more prudent in their spending, or how should they go about in general for this current situation?
Okay, actually, there's one part of the last question which I haven't addressed yet, which is which are the sectors that may still see growth. Actually, you know, if you look at what are the essential sectors that we have basically drilled down to during this 1 month circuit breaker, you know, with this work from home story, you realize that there's a mad rush. People are out there buying Wi-Fi routers, buying laptops, buying monitors, buying computers, anything basically that helps you in your work from home setup, right? So that's ICT, I think, will still do well in this kind of environment. Of course, pharma and the biomed cluster will continue to do well. In fact, you see globally, a lot of firms are now switching from the traditional manufacturing, right? I mean, even LV now is talking about making masks to meet the shortfall. A lot of firms are switching from producing typical manufacturing goods to producing kind of PPE products, right? So that's one area where there is still, you know, strong demand. And I think food supplies, you know, because now there's a lot of all these travel restrictions and flight cancellations, a lot of airlines grounding their planes. Then the question is, how are you going to make sure that global trade continues to function? So if you're still in the logistics area, probably there will still be some demand for getting critical goods out and about around the world, okay? And then in terms of where some of the opportunities are, governments are spending, they are trying to stimulate the economy, they will still be doing infrastructure projects. In fact, if you look at the government, now they want to create, you know, 8,000, 10,000 kind of jobs. You know, there will be certain short-term employment benefits that will be given out. So if it's related to public sector and healthcare type of jobs, right? I mean, you look at the world we are today. you need a lot more people doing temperature screenings, doing R&D for farmer, etc., etc. So there are still industries that will do at least fare slightly better in this kind of environment. So as for if you have spare cash, okay, you are really in the lucky group, okay, where you can consider where you want to invest your money, right? So I would say, of course, do feel free to talk to some of my treasury advisory colleagues or your RMs. They can actually advise you on where to put your money to good use. Essentially, cash is king. If you have dollars, dollar is the king of kings today in this kind of environment. There are a lot of opportunities, but you have to have the stomach for the risk appetite, because markets are very, very volatile, right? So you will see, very good names, good credits that are paying relatively high yield these days, right? Double-digit yield seems to be quite standard these days, but you have to have the stomach and you have to take some duration risk as well. So I won't go into specific names here. I think this is a conversation which you probably need to have with your relationship manager, because they will have a better KYC advice for you, and they know your risk appetite and your investment horizon better as well. Okay. But I would say generally, I think dollar looks like it's a relative safe haven until we see the uncertainty and volatility subsiding a little bit. Okay. So in terms of the business financing plans, maybe going back to my earlier story about cash management and cash conservation being king, you have to tap some of the government and bank support measures. You have to look at some of your exposures in terms of your liquidity, your credit lines. You also have to look in terms of your supply chains, right? Because the fact is, today we function in a bit of a disjointed world. So there could be hiccups in your supply chain that affects your business if your business is still running on a day-to-day basis, right? So you have to look at your FX exposure, you have to look at your credit exposure, you also have to look at your customer and your counterparty exposure as well, because you cannot assume that it's business as normal for them either, right? So if you're supplying to certain markets or your customers are concentrated in a certain market that's now facing a recession story, are there other markets that you can explore? Okay, and that's not to say that just because you have a global recession, there aren't countries that are still growing. It's not even to say that if you have a country that's in recession, there are not industries within that country that are still growing, right? So I don't think that it's a doom and gloom story. You really have to be fairly innovative. You have to think out of the box. Okay? So what are some of the alternative financing, alternatives that are possibly out there, right? I think this is really where I think if you talk to your bankers, depending on what kind of collateral you have, you may want to consider, putting some of your fixed assets as collateral if you need the upfront liquidity financing. Okay, I think the bankers may be able to structure certain alternatives for you, certain options for you based on what is your company's track record, how deep is your relationship with the bank, and what kind of collateral that you may be able to offer. So it's very hard to give you specifics of that, because I think it would be very much case by case basis. Yeah.
Okay, Selena, we've already come to the end of this session, but probably maybe what's the last thing? Is there any other last words that probably you'd like to just advise the business men during this period, especially this volatile period, and some businessmen maybe even struggling with their finances? Like, what is one thing you probably want to just let them know before we end off the whole session?
Okay, sure. I think if you have done all the necessary, which is to look at streamlining your operations, cutting costs, making the necessary arrangements for your workers to work from home, you will actually come out of this crisis stronger. Okay, you will realize that a lot of the pain, a lot of the hard work actually has been front-loaded in a sense, right? So if you survive this crisis, you realize that actually, hey, maybe I don't necessarily need all these frills. You know who your true bankers are. You know who your trusted counterparties are. You know who your reliable customers are, I think you have to look for the silver lining, and you have to keep a good attitude, right? So do focus on what is essential for your business. Think about who your trusted partners in your business are. And in terms of your employees as well, do not forget about them. Do pay attention to keeping them safe and in good health as well. I think if you keep a positive attitude, this crisis will be over hopefully faster than we all think. And then you really have a very good foundation for growth and for recovery when it comes.
Thank you, Selena. I hope that, you guys have benefit a lot from Selena's session. So we come to the end of the whole session. For those who have, questions on your working loan and finances, not to worry. We'll be sending you an email where OCBC will be holding a session on working capital on 21st April, 3 p.m. And you can join the webinar, and we will have a panel of experts from OCBC to be guiding you through all the different questions that you have. So let us know. Thanks, Selena, for today's session. Thank you so much. And we'll hope to see you soon in future again. Thank you.
Thank you.
Thank you.
Bye.
Bye.